As we visit with you here in late June 2025, we are examining the financial market response to the United States joining Israel in its war against Iran, which was affected by the U.S. attacking Iranian nuclear weapons installations. The assumed playbook of this type of geopolitical development would be lower U.S. equity prices, lower interest rates as investors buy U.S. bonds, and higher oil prices, which ultimately could harm economic growth. The initial market response, however, did not exactly follow that playbook, as equity prices rallied higher and oil prices were lower. The widely followed S&P 500 equity index increased a little less than 1% in late Monday trading, which was the first market trading day following U.S. involvement, and oil prices, using the West Texas Intermediate or WTI price per barrel, decreased nearly 6% from Friday's close, trading below $70. Only interest rates followed the expected geopolitical script, as the U.S. 10-year Treasury yield did move lower to 4.31% from 4.38% at the close of last week. We believe that markets are assuming U.S. strength and that tensions do not escalate from here, and that peace negotiations remain possible. Expectations for Iranian retaliation were met based upon confirmation of missile attacks on U.S. military installations in the Middle East, but early reports indicate there were no casualties. In the investment community, as stewards of client assets, we're closely attuned with the financial market response, and especially the big picture, as geopolitical uncertainty adds to unknown outcomes for tariff and trade policy, passage of the budget bill, and U.S. economic growth in 2025 and 2026. U.S. equity markets have been very resilient in 2025, as pathways to economic growth are visible. The S&P 500 was up 1.5% year-to-date as of June 20th, 2025, and was less than 3% below its all-time high set in mid-February. At the same time, however, we believe that a lot of good news is now priced into equities, and investors should avoid becoming overly complacent. Investors should scale back return expectations in the months ahead, and a return of volatility is possible. Key developments we are watching include, President Trump's 90-day pause on reciprocal tariff expire on July 9th, creating some urgency as we acknowledge that multiple important trade deals remain unsigned. The U.S. Federal Reserve Bank has kept short-term interest rates higher than expected, primarily due to trade policy uncertainty. The congressional Big Beautiful Budget Bill has passed the U.S. House of Representatives, but is facing expected changes in the Senate. Congress has targeted passage by July 4th, which is now just 11 days away, including weekends and holidays. Investors could be disappointed if the bill is delayed. Estimates for U.S. economic growth have receded since March, despite easing trade tensions. For a brief period in March and April, recession fears were building, but extreme economic weakness became less likely when the president pivoted away from tariffs toward trade deals. For now, that should provide market support on weakness and creates optimism. But a return to punitive tariffs and/or wider U.S. involvement in the war could change that equation. We believe that a prudent strategy is to remain invested in high-quality diversified portfolios, look for companies with better than average earnings visibility and solid cash flows that support capital investment, as well as returning cash flows to shareholders through buybacks and dividends. In a period of expected moderating equity returns, dividends become a larger percentage of total return, and we look for companies that produce net income that exceeds their dividend commitments. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.